Hello, I'm Ben. Welcome to the channel. Today we're going to talk about mortgages and a little bit about buying a home and refinancing a home and how a mortgage works in general. Here's the reason why. A lot of people get intimidated by the thought process of buying a home or getting a mortgage. Some people stay in rent for years beyond what they should because they're unsure or feel unsettled about buying a house or getting into a mortgage. Here's how that works. If you're in a lease and you're paying rent, you're already using the same amount of money and the same contractual obligation that you would use with a mortgage. So when you're signing a lease for rent, you're guaranteeing someone you're paying a rent price every month. And when you buy a mortgage, when you buy a house and utilize a mortgage, you're saying the same thing. You're going to pay this amount every month over a long period of time. The difference is in rent, you're burning that money. You will never earn anything back on that. That's money that is gone. On a mortgage, you're buying equity. So the more you pay into the house, the more of the house value you own. And as you work your way through the mortgage and pay your mortgage off, you own all of the equity in the house, which is a bankable value or a cash value. So let's talk about mortgages real quick. There's a few steps, and I'm going to burn through them quickly because I don't want this video to go too long. I was in the mortgage business for almost the better part of a decade. I enjoyed it very much. Putting people in homes was very fulfilling to me. I enjoyed it. I enjoyed how people felt when they did it. And I myself, as a homeowner, would not like to go back to not owning a home because there's several things that you don't think about. So once when I was traveling for work, I had to rent an apartment in a couple different states and have an apartment there. And my home was here. And I was not coming home every week. I was not coming home for months on some occasions. And so I'd have this apartment where I had to deal with apartment life. In apartment life, you get very used to things that people that live in homes and own homes aren't accustomed to. Parking for one, right? Having people jack with your vehicles, having people mess with your stuff, having people park so you have to walk across a parking lot to take the groceries in and everything because a bunch of idiots have blocked up the doors and there's no spaces close to the building. Stairs. If you don't smoke or if you do smoke, what's coming through the walls. One of the things I hated most when I had to rent a place up in Iowa was everybody in that building, with the exception of me, smoked weed. And every time I came to that apartment after working 14, 18, 20 hours straight, the whole place stunk. I mean, it was like skunk year round. So I had to open the windows so my apartment would smell okay because all these other people are burning everything that they could burn in the building. So you don't have to put up with that when you own a home. Now, don't get me wrong. Some homes and condos and some things where you buy an apartment in a building, etc. I'm not talking about that. I'm talking about a single family residence, a house that's on its own in a yard, etc. That's what I'm talking about. That's the majority of homes in America, that's what they are. So you have this house. You don't have people sharing a wall. So it's not extremely loud. Sometimes in townhomes and things like that you do. But home ownership gives you a piece of your, I always say this from a psychological standpoint, there is history and there is proof that from a psychological standpoint, owning a home, living in your own home, not only does it give you a sense of pride and enjoyment that you have this for yourself and you've made that point done, but you also feel like internally that you have a place in the world where you belong. So no matter what goes on in the world, you're still okay because you have your place. And in your place, you get to be you 100% of the time, and the rest of the world doesn't have an opinion. And depending on where you live, the world can have less of an opinion than normal. All right, so we'll jump through the ideas of purchasing a home. Purchasing a home is utilized in the mortgage. That is a mortgage that's utilized in buying a home, right? There are a lot more refinances done every year than there are purchases. Okay, so everybody that owns a home could refinance. Everybody that's buying a home will use a purchase loan. Okay, there's a lot more people living in homes every year than there are people buying them. So that should make pretty good sense. People's thought process normally goes to realtors when they're thinking about a mortgage. That's a mistake. A realtor is not a mortgage broker or a loan officer. Some of them are. Most of them have loan officers or brokers that they work with. Why do you want to use a mortgage broker and not your bank? Your bank, even the bank you've dealt with your entire life, will sell you a mortgage to make as much money as they can off of it. All right. They will make all that they can off of the mortgage they sell you. The way it works is, whether you use a bank or you use a broker, is you supply your documents, your financial documents and your identification documents, the same documents you apply when you take a job. So a driver's license, social security number, financial documents, W-2s, or 2 years tax returns. That's what you supply them. When you give that to the bank, when you give that to the broker, they will pre-qualify you for a loan. And based on your debt to income and based on a verification of rent, if that's what you're doing renting, they'll send a verification of rent to where you rent. They'll get 2 years rental history and say, look, this person has no problem paying $800 to $1,000 a month in rent. So they can afford that in a mortgage payment. They'll get all those documents together. And once they have that, now you're pre-qualified for a loan. So this information would determine what size payment you can handle and which house you can buy within that. So once you have what you're pre-qualified for, you can go out and find houses that fit within that range. 100% of the time, if you get pre-qualified for $176,000, a realtor will go and try to find houses that are worth $176 to $180,000. Okay? And what they try to do is finagle the numbers so it makes sense and it gets in there. That's not how you want to buy a house. Okay? If you buy a house, and this is my opinion, if you buy a house and you're qualified for $175,000, you should be looking for something between $160 and $170. You don't need to go to the max end of your income. Now, yes, theoretically, your income should improve and increase through your lifetime until retirement, which means you should earn more 3 years from now than you are right now based on just the standard cost of living, etc. But why do you want to max out at the risk? So if you can afford 175, why are we talking 176 to 180? Because you can afford 175. Anything more than that's going to be painful. Then you got taxes and insurance you need to consider. Taxes and insurance increase over time. Insurance may decrease at some point once you've been in the house for a certain period of time, but taxes, this is America. The government doesn't know how to spend money and they don't know how to work a checkbook. So taxes are always going to be taxes, right? And until we figure out that property taxes should be illegal, that's going to be something you have to face. So why you say, well, Ben, why would I buy a house if I have to do taxes and insurance? Simply because of this. If you rent and you don't have renter's insurance, if something burns down in your building, you lose everything you own. You're still going to want insurance either way. So that's a wash. Taxes, when you pay taxes on a home, you get tax benefits from that. End of the year, you get all sorts of rebates, homeowners rebate, homeowners household rebate. You get all these rebates. When in renting, you do not. Okay? So a company takes those write-offs. You don't. So you allow yourself more financial opportunity by owning a home and getting a mortgage. All right, so we'll jump into the detail. So let's say you decide you want to buy a house. You go and you get your broker and you get pre-qualified. You're doing it right. The broker most likely works for the realtor. The realtor, you'll tell them, hey, I got pre-qualified for 175. And they're all right, I've got a bunch of houses between 180 and 185. And you're like, no, I want to look at houses between 165 and 170. That's what I would say. So now the realtor goes, okay, well, if you find something close to that, we'll make it work out. So this realtor is referred to you by your broker or your loan officer. So they go and they get a list of these homes, and then they start taking you around to see these homes. You finally see one that you like. The next step is you have your realtor put a contract in on the home. You don't need a realtor to do that. You can put a contract, and most title companies and most mortgage loan officers can do that for you. They work with companies that can do that for you. But if you have a realtor do that, they can do that. They can put a contract on the property. Realtors then go back and forth sometimes and create all kinds of headaches about who's paying who and how, and it gets paid through the sale of the house, et cetera, et cetera. If the house doesn't have a lot of equity in it, there may not be a room for all that noise. So the realtor may jack up a deal because there's not a way to do that. Here's what I say about realtors, and I'm not anti-realtor. I just say that is the piece that should matter the least to you, okay? 99% of realtors turn over every year. Look it up. 1% of the people that are realtors today will be a realtor this time next year. I know several that have been in the business 20 plus years, okay? There are great realtors out there, but you have to settle that for yourself and find one that's trustworthy. Here's the thing about a bank. A bank doesn't have to be, their representatives don't have to be licensed to lend their money. If you're dealing with a licensed mortgage broker or loan officer, they have to be licensed in the state that they're in. which means they can't be jiggy. Just like in the insurance business, they have a producer's number. So they're licensed, they've had to take courses, they have to do continuing education courses every 2 years to keep that license in good standing, and they can't do anything that's felonious or advanced misdemeanors. They can't do that or lose their license. So you're dealing with good people when you're dealing with licensed folks, okay? When you're not dealing with licensed folks and there's banks lending their money, that's when you run into the issues with people doing things that are not on the level. And so just to go into a slight caveat there, back in 2008 when everything went wrong, it's because mortgage brokers and loan officers were required to lend what was there. If you don't lend what banks have available, it's called discretionary lending, and that's against the law. So what you had was a bunch of banks pushing loans that were no documentation loans. So someone would come in and say, I'll make $1 billion a year. And they all right, well, here's a house that's worth that. And then these people would do it. And, all of a sudden, I don't really make $1 billion a year. So I can't pay these payments. Well, what do you think was going to happen? Okay. So that's kind of how that worked out. It was very jiggy and it's stupid. So that's why you want to go with reputable people that make sense and that do this professionally and have a license that says they're educated, they continue that education every year, and they take pride in what they do. And the longer they've been in it, the better they're at. I do miss the business. I wish I wouldn't have got out, but I moved from those states that I was in when I did the business and got into a different business at the time. But I'll say this, through mortgage, when you own a home, now your payments each month are going to buy you equity, which is an asset in the long run. So let's go through that. So you buy a house, you have a contract, you're already pre-qualified. Now you'll get those financial documents to the title company, to the lender. They'll review all those. The house will have to be appraised, and it must appraise for what they're asking to sell it for. If it doesn't, then the sales price has to come down. If it appraises for more, then lucky you, because you've got it under contract, hopefully. And then there's a tax certification that proves the taxes are caught up. And then there's a title that proves there's no work liens, etc. on the property. If, say, a plumber fixes plumbing on a house and never gets paid, he can go and have a court put a mechanic's lien against the house. When the mortgage is paid off and the house trades hands from one owner to another owner, those things have to be paid off through the close of the mortgage. The way the house is purchased is your loan that you get, your mortgage company takes that money and pays all that stuff off, and now you own the house. They hold the note until you pay it off, and they hold your equity until you pay it off. And so at some point, if you sell the house, they will pay off what's left of their loan and send you a check for the difference. That's how that works. So equity is like this. If you have a $100,000 house and you owe $80,000 on it, then you have $20,000 in equity, minus certain fees, right? So if the house were to sell and you owed 80, then the bank would keep the 80 and you get a check for the 20. It's $100,000 in the value that you sold it for, if that makes sense. All right. So back to the mortgages. Just to be quick about it. So you've put in a contract on the house, you've been approved for your financing, now the house has to do the appraisal, the house has to do the inspection, and the house has to get through the title. All that's got to be clean and got to be able to be covered in the mortgage note. If there's anything less, that goes to the seller as cash out for the house that they sold, okay? So when you're doing that, and you're moving through the loan process from a purchase, it doesn't take very long, okay? It should take around 45 days, max 30 to 45 days to purchase a home. And the more common the house is, the better because there's more there. There are comparables. When the appraiser does the appraisal, they'll look at houses in your area close to this house within a few miles. If it's more rural, that area will expand some. They're looking at houses the same age as yours, same bedrooms, bathrooms, 2 stories, 1 story, etc. And they're seeing what they actually sold for. Doesn't matter what people list houses for, it's what they sold for that matters. So those comps, and that's what they're called, they're comparables to your house because they're similar in age, like, and design, etc. And sometimes you have rare houses that don't have comps that are very similar, but they'll go by age or 1 or 2 of those things. And then there's a tax value. So every house has a tax value in the county that you're in. So you could look at any house in the country by going to the county tax assessors, seeing what the tax assessor says the house is worth, and that should be what it's worth plus about 15 to 20%. So your taxes will be 15% less than what the house is worth. So if you get an actual value, you take that tax value they have there, you add 15 to 20%, and that should be a reasonable price for the home. In some areas that fluctuates So you want to use an appraisal because some areas there's been housing shortages for a very long time and the prices and taxes are through the roof. It gets to the point where people can't afford to live there. So that tells you a little bit about the mortgage. When you get close to closing, so once all those components are put together, so in a purchase, it's the contract, it's the appraisal, it's the inspection, it's the title, it's the tax certification. That's what's in the house has to qualify for. And then you have to have your identification, your proof of income, and then the history of that income, and then most likely a verification of rent or previous payments to show you can support that ratio. If your debt to income isn't bad at all, they won't ask for a VOR, that verification of rent. That's just how that works. Once all that's in the file, you can now complete the close. And so what will happen at that time is they'll pick a close date, and then you'll go in and you'll sign the documents. The lender at that point has already approved anything, and they've approved close. So you go in and you sign the documents. You do it in front of an attorney at a title company. In Texas, they require it by law to use a title company. A lot of states have followed that now. But you do that in front of that attorney, that lawyer, or one of those lawyer's aides. And once you have that signed off, the whole pack will then go to underwriting. Most of it's digital docs now, and it's over there in a matter of hours. They will then look at that, and it may take 2 or 3 days. And once it takes 2 or 3 days, then that loan will fund. And once it funds, you own the house. Everything else from the prior owner is paid off. Now you get to have the good time of setting the electricity in your name, the water, and all that jazz, which that in itself can be worth the whole deal because it's funny and it's a good time. I'm being facetious. Sometimes that's very annoying. But now you own a home. So that is the purchase process, okay? And a realtor may take a percentage off of that. The buyer and seller realtor take all that. That will come out of the back end. You, the buyer, don't have to worry about that unless you did additional because you were trying to move something quick. Typically, that comes out of the seller's end, and those two realtors will agree on that price. I personally, if I'm buying a house, I'm not paying a realtor anything. The seller can pay the realtor because the seller wants to sell the house. I'm here to buy the house. I'm not here to pay a bunch of fees on top of buying a house. That's the way I view it. Okay, so that is a purchase mortgage. The other type of mortgage, the more common, is refinance. Okay, so people have lived there. They have a rate that's going to vary. They need some cash out, or they want to get a fixed rate note or a shorter note. So here's how that works. So when you buy a house, you're looking at most likely an 80-20 loan, which means 80% is the primary loan, and it'll be a lower interest rate. And then you'll have a 20% loan, which will be at a higher rate. You can get them either fixed or adjustable, and I'll go into that in just a second. But 80 and 20 adds up to 100. Sometimes companies will do 110, 117% loan to help roll in the closing costs, etc., if you want that. But most of the time, you're looking at an 80-20 situation. If you're a first-time home buyer in the United States, you can use an FHA loan. Use the FHA loan if you qualify. And if you're in the military, you can use a VA loan. The VA loan and the FHA loan are pretty much the same loan. The beauty of those loans is whereas you'd have to put 20% down in most situations to buy a house, in an FHA situation and a VA situation, you only have to put 3 to 5% down. So on a $100,000 house, you're looking at paying $3,000 to $5,000. Now, there's other closing costs that you might have to put in there, but as a down payment to the note, it's 3 to 5%, meaning you're borrowing 95% or 97% or whatever those numbers work out to when you do a VA or FHA loan. Now, when you borrow more than 80% against a property as a mortgage, you're going to have to pay PMI until you get below that. PMI is called private mortgage insurance. It's not helping you. That protects the mortgage company. If you default when you owe more than 80%, that covers the gap for them should they have to sell the house in a fire sale because you lost it, okay? So PMI does not help you. If you do an 80-20, that should protect you from PMI. If you're doing 85% or more, on a loan, you're going to have to pay PMI. 80-20, sometimes you'll have to because you're still doing 100% because PMI companies figure that out. That's the way to do it. It doesn't protect you. It protects the bank, the financier. Okay? So that's how that works. There are two types of mortgage loans. Two types. One is fixed. The second's adjustable. And it's very simple. A fixed mortgage, the rate stays the same for the entire term of the loan. The term of the loan is the length of the loan. It can go 5 years, 10 years, 15 years, 20 years, 30 years. There are some longer than 30 years. I don't know why. Okay. And then you have an adjustable loan. Typically, that's a 3-year, 27-year ARM, or it's a 2-year, 28-year ARM. ARM stands for adjustable rate mortgage. So it's fixed for 3 years, and then the next 27 years, it'll fluctuate based on the market. That typically means it's going up. A 2-year, 28 years, the same. It's fixed for 2 years, and then it will go up after that. My suggestion, and this is my opinion, talk to your accountant, my suggestion is you go with the 30-year fixed. 30-year fixed rate, you're paying less payment, and it's fixed over the entire life of the loan. And as you do better and make more money, you can send more each month and pay that off faster. But if it's lean and you go through some tough times, you still just have to make that minimum payment. If you go with the shorter term, your payment's going to be greater because you're paying off the same amount of money in less time. So it's better, it's a safer option to get a 30-year note that is fixed. Send an extra payment a year and you'll pay that loan off between 7 and 11 years versus 30. And if you take your mortgage payment and you multiply that times 12 and then multiply that times, the 20 years that you saved from paying it in 30 years versus 11, look how that adds up. It can be a huge amount of money because what it's doing is you're not paying the interest over time that you would be paying on the note. So that's the difference between fixed and adjustable. Refinance is pretty straightforward. You can do 2 types. You can do a refinance that just gets a lower rate and lower payment. So that's a straight refi is what that's called. Or you can do a home equity line of credit or HELOC, or you can do a cash out mortgage. The HELOC and cash out are the same. They both are documented the same. Typically, states will limit how much equity you can take out. Meaning, I bought a $100,000 house. I've paid it down. I've got $30,000 in equity. They'll only let me take 10 cash out because I have to maintain 20 in equity. That was the law in the state of Texas back when I was doing mortgage. So there's 2 different types. There's a cash out loan option that is a mortgage where you're getting cash out, and there's a straight refi, which is just getting a lower rate and a fixed price. Sometimes when you do a straight refi, your company that you currently carry the mortgage with, you don't have to go through a lot of stuff in closing. Sometimes that can be a rapid type situation to speed you through that. So that's a little bit about mortgages. There are great references out there. This one is Home Buyers for Dummies. I'll recommend that one. That's got a lot of great stuff in it. It is heavy on the realtor stuff. This one's all about mortgages. It's less on the realtor stuff and talks about mortgage packages. That's the rule, all about mortgages. That's the title. I actually used this book when I was studying for the state exams back when I became a licensed loan officer. And I think that's who you should use. So just want to put that up today, just a little bit about mortgage. Hopefully it was useful to you. And if there's questions, put them in the comments and I'll respond. But the best way to find out about mortgages where you are is to reach out for a state licensed loan officer or mortgage broker and see how they can help you. That typically they know the laws, they know what's going on because they're there and can support you with those questions, those things. I hope this is beneficial. Frankly, when you talk about buying a house or not, there are a lot of schools of thought that say you shouldn't buy a house. I think those are wrong. I think the psychological comfort of owning something that's yours, having a place where you can be you all day, all night and be fine, and a place that you can retreat to when you need to get out of the world, I think that's second to none. When you live your whole life in communal living, apartments, etc., that's great too. People buy condos, people buy floors, people buy apartments in these buildings. That's fine if that's what you choose. Either way, it's yours, and you still have that sense of ownership and that it's me. One other thing I would say is watch out with homeowners associations. When I was in the mortgage business, I did have three customers that lost their homes because the mortgage was too tight. There wasn't enough equity there. And so either we could have refinanced the house if the HOAs would have forgiven the fees that were owed, but they didn't. So in those two instances, those 3 people lost their homes because they were in areas that had HOAs. So that's just red flag. Make sure you're paying attention to that. I personally am not interested in people telling me what to do on my property, so I have no interest in HOAs. I'm pretty anti-HOA. But in this country, we're getting bigger and bigger on telling people what to do, where they are, and where they live. So just pay attention to that. It does have an impact, and it can get in your way if things go bad for you. So hopefully that answers some questions. I've gone a little bit longer than I wanted to in this video. Just want to get something out there. Somebody asked me some questions about mortgage the other day. Look, it's nothing to be intimidated by. If you've bought a car, you've done something almost as difficult as buying a mortgage. If you've gone to college and had to do applications and go through financing for college, you've done something that's more difficult than a mortgage. If you've adopted a child, you've done something that's more difficult than a mortgage. So just know that it's out there, it's common, it's safe. If you use the brokers and the licensed professionals and you don't get handled, have a price knowing what you're comfortable with going in. Stick to your budget. Don't let someone talk you out of your budget, because you want to be comfortable and appreciate your new home. You don't want it to be a burden to you inside of this first or second year because someone talked you into buying more house than you needed. Okay? I'm Ben. Hopefully this was useful. Be good.